Hey everybody, it's Ken McElroy here. And of course, we got George Gammon on. And if you haven't watched his stuff, he's got 250,000 people watching on his YouTube channel. He's a walking encyclopedia when it comes to Bitcoin, stocks, bonds, where the economy is going, fiscal policy, monetary policy, all that kind of stuff. And it's super confusing. And so Robert Kiyosaki and I had dinner with George the other night, and I'm peppering him with questions, and he's answering them. Most of the time they're pretty hard to find. So George, welcome to the channel. I appreciate you being here.
Thanks for having me. I really look forward to the discussion.
So, all right. So let's get right into it. So I've been watching, the Fed is like really involved these days. They've gotten involved in the stock market. They've been buying stocks. They've been buying corporate bonds. They've been buying ETFs. They've been propping up mortgages, and the Fed is basically we're partners with the Fed right now. And so can you talk a little bit about what's going on, because it's not really a free market like it used to be before. Yeah, right. So I think you got a lot of people just discount what's really going on. And every single week, every month, we see these articles coming out about what the Fed's doing. And if people aren't paying attention to the Fed and how they're really, really, really involved in these markets, I think it could be a big mistake for their, how they're investing in the future. What do you think?
I completely agree. I think it starts by defining and understanding what makes a society wealthy. And for a variety of reasons, I think we've been brainwashed to believe that these green pieces of paper or whatever electronic digits we have in our checking account, that's what makes us wealthy. It's not it. It's not it. What makes a society wealthy is the quantity of goods and services it can produce efficiently, and hopefully more efficiently, meaning cheaper, over time. And if you want an example of this, and I take this from my good buddy Peter Schiff, you've got to imagine you were on a deserted island. And you've got some salt water, you've got some sand, you've got a few coconuts, and you've got this chest full of $1 billion. Are you rich or are you poor? Well, the answer is you're poor, because all you got are a couple of coconuts and some salt water, right? So that just goes to show you that it's not about how many currency units are out there. It's not about, how high stock prices are or bond prices or even gold and Bitcoin for that matter. It has to do with how efficiently the society produces goods and services. So going back to your point there, when we look at what the Fed's doing in distorting is the best word to use, markets, distorting the economy, misallocating resources, creating malinvestment in the economy, you have to ask yourself over the long term, does this create a foundation where our economy will produce fewer goods and services or more goods and services? And when you have these distortions, when you misallocate scarce resources with alternative uses, the conclusion you have to come to is that our economy will create a lot less stuff moving forward than unfortunately it did in the past. What does that mean? That our society will be poorer as a result. I don't care how much UBI we have. I don't care how much MMT. I don't care how much the Fed can prop up the stock market. It doesn't matter. And again, no certainties, only probabilities. But in my opinion, the probability is highest that we're going to be producing less stuff in the future. Therefore, as a society, unfortunately, we will be poorer.
Yeah, that makes a ton of sense. So I've been watching the Fed. We watched it in 2008. It kind of jumped in and mostly around the banks. And now it's like going right to the people. So let's talk about since the pandemic started, what's the Fed doing differently? Because we went from, I think it was 3 trillion to 7 trillion. or 4 to 7 or something like that, just like that. And we're not even, obviously we're not even through it. And we have all of 2021 coming up ahead of us. So, the virus is spiking, and the vaccines is not even distributed yet, and businesses that we're going to have a lot more closures. And so, what's the Fed doing differently now than they have been doing? Because it kind of bumped along, and I guess it was kind of not really noticed too much. It was talked about here and there, but now they're like really active.
Yeah, there were a lot of structural flaws with the economy. The coronavirus, that was just that was a symptom. That wasn't, or that kind of was the straw that broke the camel's back. But the economy was in serious trouble before COVID. And if you want proof of that, just go back to September of 2019, when the repo market, the rates in the repo market spiked to 10%. That's the dollar funding market. That means we got big problems. We got real big problems. And the Fed had to reverse their quantitative tightening, which is actually selling assets. And then they had to start QE, now QE infinity. and let's put things into context. And we have to understand the economy is like a heroin addict, right? And it's on heroin. But in order to get that same level of high, just like any other drug addict, you have to give them more and more and more drugs. And that's basically, when you're talking about the Fed's balance sheet, you could just replace that with the word heroin.
Yeah.
Right? So going back to, prior to the GFC in 2008, the Fed's balance sheet was very consistent, right about $800 billion. Then we have quantitative easing one. And remember, what Ben Bernanke said after QE1 is that this was just temporary. Remember that?
Yeah.
He comes out, this is just a temporary, it's an extreme measure. We're just going to do it this one time. And let's also remember that when they first came out with quantitative easing, it wasn't QE1, because they thought they were only going to do one round of quantitative easing one. So they didn't need to number it.
Yeah, it was a QE. Yeah.
But then, and that takes the Fed's balance sheet, right off the top of my head, to maybe 1.5 trillion. Then we go quantitative easing 2. Then we have quantitative easing 3. That gets the balance sheet up to about 4.5 trillion. Then what happened is they tried to reverse course, and they tried to reduce the size of their balance sheet by selling some of those assets they had purchased. Their balance sheet got down to about 4 trillion. And that's when all hell broke loose in the repo market. So what that's kind of telling you in a roundabout way is now our heroin addict needs an additional $3 trillion worth of heroin just to survive. And that doesn't include if our heroin addict gets sick with, we'll call it the flu. Yeah. Right? If our heroin addict gets sick with the flu, then they need 7 trillion worth of heroin. They might need 10 trillion worth of heroin just to maintain the same level of high. And what you've noticed is that the balance sheet of the Fed can never go the opposite direction. To think that we're going to go from 7 trillion back down to 800 billion is a complete fantasy. So what that means is the process of taking the balance sheet from X to Y has distorted the economy in such an extreme fashion that in order for us to get back to a point where fundamentally we had a healthy economy that was really growing, it would take a complete collapse of the system. And I don't like to say that, but it is what it is. And if you look at a lot of the experts that I talk to that know way more about this than I do, they all say the same thing.
So George, how is all of that creating the asset bubbles? And if you would, could you just talk a little bit about the repo market? Because I watched your videos on the shadow banking and the repo market. I think it's fascinating. I think a lot of people did not really understand or even know that we had this spike in September of 2019. So can you tie all that together? Because I think that's really important because COVID kind of it's exposed everything.
Yeah. Yeah, that's a good way of saying it. So as far as, let me try to tackle that in two separate parts. So part one, how does the Fed's balance sheet affect asset prices? Was that it?
Yeah.
Okay. The Fed expands their balance sheet by buying assets from what they call primary dealer banks mostly. And these assets would be treasuries, mortgage-backed securities. And how do they buy them? They create new bank reserves just literally out of thin air. They say, okay, JP Morgan, we're going to buy $1 billion worth of treasuries from you. And JP Morgan has an account with the Fed. So the Fed just credits their account $1 billion worth of new bank reserves. And that's kind of like an asset swap. So those treasuries go onto the asset side of the Fed's balance sheet. And that is replaced by $1 billion worth of bank reserves, which now is a liability of the Fed, an asset of JP Morgan. Okay. So really from JP Morgan's standpoint, the only thing that changes is they're just trading treasuries, in this case, for bank reserves. Where most people get confused is they think bank reserves are just like money, they're not. They're not. And most people think that the banks themselves actually lend out these bank reserves, and that's what creates new additional loans. And that's a faulty way of thinking, and the devil's in the details there. Because when if you think that the banks lend out reserves, you see them as intermediaries, and they're not. They create the money supply in the real economy. So the only thing those bank reserves do is back up new loans. So if they have $1 in bank reserves, then they can create, let's say, $10 worth of loans in the real economy. And that means M2 money supply would increase by $10. Another way of saying that, there'd be an additional $10 in the real economy chasing the same amount of goods and services.
Right. Through leverage, basically.
So yeah, that's how, and then when that loan is paid off, then the money supply decreases. Okay. But the bank reserves never increase or decrease. It always stays the same. The only thing that can decrease the bank reserves or increase them is when the Fed buys or sells assets. Okay. That's it. Right. All right. So my point is that the commercial banking system in that example had to take an action. They had to create a loan. They had to do something. If the Fed just comes in and creates bank reserves, it's just really an asset swap. It doesn't, the Fed could take their balance sheet to 20 trillion and a quadrillion, and it really wouldn't matter. But in practice, it does, because it expands the balance sheet capacity for those banks, and therefore they can go out and they can create additional loans. Now, what we discussed earlier is the banks are now, since the GFC, they're looking around the real economy, they're looking at the risk reward and saying, we don't want anything to do with this. We don't want to create more loans. We don't want to create more productive loans for entrepreneurs to go out there and create more goods and services and make the society richer, because we see too much downside, not enough upside. Especially too, let's remember, because the Fed drops rates down to zero. Right. So the banks have a hard time lending out money at a sufficient hurdle rate. Right. So what they can do, they say, okay, well, we've got to make money somehow. So if we don't want to lend out to the real economy for productive lending because we don't like the risk reward, okay, why don't we just maybe give it to these hedge funds or create loans, additional loans for hedge funds or financial institutions, and they can come in and they can drive up stock prices, or they can create some sort of derivatives, do interest rate swaps, or we can go into the repo market and we can kind of, again, financial engineering to try to get the same type of return on our investment with a lot less risk, because we know the Fed has our back, meaning that whether it's real or just psychological, they think that the Fed won't allow the stock market to go down more than, let's say, 15%. So they can just lever up, go into these risk assets like stocks They know that their downside is capped because the Fed has their back. But as the Fed continues to print money, or create more bank reserves, most likely retail will see that, pile into their 401k. And we didn't even talk about passive funds. That's a big, big deal. Those passive funds are indiscriminate buyers. They buy, drive stock prices higher. So the point is, the risk reward for the banks is superior, although it's very perverse. It's superior by lending it to these financial institutions instead of out into the real economy. That's why when the Fed increases their increases their balance sheet, most of the time you see risk assets go up.
I see. So is this why guys like that I follow, like Jim Rogers and Peter Schiff, and everybody says gold and the stock market's just going to keep going up because of all of this stuff going on with the Fed?
Yeah, so they break it down into very simple terms and just say, listen, if you got all this money printing, that means more money chasing goods and services. That means gold goes up, and most likely stocks go up as well. I think Schiff would argue that foreign stocks might go up more because as an American, you're going to get kind of a double whammy in the sense that your foreign stocks will go up, but they're denominated in a currency that will appreciate against the dollar. Mm-hmm. So a little bit like your Canadian trade or your Canadian bet that you had back in 2010 or 2011 there. You had a double pop on the appreciation in the Canadian dollar.
Canadian dollars in that were par with the US dollar, invested them, and then when we returned them, the dollar had gotten stronger. So their dollar they made the VIG on their dollar, and they made it on the real estate, right?
Exactly. Yeah, that was, not to go off on a tangent, but that's the exact same thing that I did in Colombia when I started investing there in 2015. It was the exact same mindset. So now the second part of your question was the repo market.
Yes.
Repo market is probably, from a macro standpoint, the most important, or one of the most important things in the world. And it's really the center of the dollar funding markets. And since the dollar is the world reserve currency and is used in something like 80% of the transactions globally, if the hub of that is the repo market, which it is, then it's the most important, financial thing that there is in the macro space. And I don't want to go too far down the rabbit hole, but there's also a market. Then you talked about shadow banking, and there's these banks that are in the shadows, meaning outside of the domestic dollar market. So the Fed really cannot quantify this. No one really knows how many dollars are created outside of the system. And this is what we call the euro dollar system. So the euro dollar system has created a lot of the dollar debt in the world to finance global growth. Because if you're a factory, as an example, in, let's say, Colombia, and you want to try to get a dollar denominated loan because the majority of your, let's say you're oil export or something like that. So your revenues are going to be denominated in dollars. And sure, you could get a peso denominated loan, but it's going to cost you 15%. Or if you get a dollar denominated loan, you might be able to do it for 5% because the person lending you the money doesn't have as much currency risk or inflation risk. Right, so you can get a lot more bang for your buck. Now, most people assume that Colombian corporation would have to get those dollars from an American bank. That's not true. So they could potentially go to a European bank, say Deutsche Bank, and they could get a dollar loan, let's say for $100 million, and Deutsche Bank created those dollars out of thin air. Just like our example, when the U.S. commercial bank had the $1 in bank reserves and they created $10 worth of loan in the real economy, $10 of additional dollar denominated money supply, Deutsche Bank can do the same thing. Right? So then you say, okay, well, if that's outside of what we can quantify, no one knows how many dollar denominated loans are out there. The Bank of International Settlements assumes that it's around 13 trillion, but there's many experts that I talk to, and I think would know more than the BIS, and they peg it at maybe 30, $40 trillion worth of dollar denominated debt outstanding in the world. So my point is that entire system functions on the back of the repo market in the United States. So if the repo market isn't functioning, that whole entire system collapses. If that whole entire system collapses, we've got something that looks way, way worse than the GFC. In fact, that's really what the GFC was all about. Most people think that it was about mortgages collapsing. No, it was about the repo market collapsing. That's what happened. That's what took out Lehman. That's what took out Bear Stearns, was the repo market collapsing, and them couldn't get they couldn't get the liquidity they needed because they had all of the garbage debt. But the garbage debt really the garbage assets, like the mortgage-backed securities and the asset-backed securities, that really wasn't the straw that broke the camel's back. If they would have been able to access the repo market with all of that garbage collateral or all that garbage they had on their balance sheet, they still would have stayed in business. It's that they couldn't access the repo market. They couldn't get the overnight funding they needed to pay the bills. And so they had to just wave the white flag. So the repo market is basically, you're a bank or you're a financial institution, and you have collateral in the form of US Treasuries, let's say, and you say, okay, I want to submit this collateral into the market because I need $1 billion for 3 days. And so they have a specific time frame on it. Most repos are overnight, but some of them go 30 days, some of them 60 days. It's just between the two parties that are doing the transaction. So they'll put up, let's say, treasuries in this case as collateral. And then from maybe a primary dealer bank, whatever, they'll give them the $1 billion. And then in 30 days, they'll just swap back. So it's all this short-term funding going back and forth that produces the ability to do the long-term funding in dollars that we were talking about earlier.
Okay, so it's bank to bank. So how did it spike in September of 2019 when it went up 10%? What happened?
Well, there was a few different things, and it's not just bank to bank. It's kind of financial institution to bank or financial institution, meaning there's a lot of hedge funds.
Got it.
Use it as well, like Bridgewater and whatnot. So anyway, when it spikes, that just means that there's a few things. It could mean there's not enough dollars, there's not enough liquidity, and therefore the demand for that liquidity drives up the price of the money, which is the interest rate. Or a lot of smart guys. First guy that comes to mind is a buddy of mine named Jeff Snyder, who knows this stuff like the back of his hand. He would argue that there could have been some issues with the collateral. So basically what happens is, if you've got treasuries, that would be, if you put that into the market, you're going to get a much better interest rate because there's a lot less perceived risk there. Where if the only thing you have to issue into the market are, let's say, mortgage-backed securities, you might, instead of your 1% interest rate, you might get an 8% interest rate. And most people don't realize that, they see the overnight rate in repo, and let's say it's 2%, and they just assume that every single repo transaction that night closed at 2%. But that's not the way it works. That's just an average of all the repo transactions. And there can be trillions of dollars worth of repo transactions daily. And that's just in the US market, right? So if you have a 2% interest rate on average, you could have some deals closing at 8% or 10% or whatever. So if Snyder said, okay, we got this, there was a perfect storm basically, and you had a lot less pristine collateral that would trade at a lower interest rate. So the only thing that they had to access was this garbage collateral that drove up the interest rates. They might also say that you could have had some potential counterparty risk in there where no one wanted to lend. So that huge counterparty that had to have the liquidity kept bidding higher and higher and higher and higher, because if they don't bid and pay 10%, they're going to go out of business. And so that was about the time where Deutsche Bank and HSBC, to name just a couple, were on really shaky ground. So a lot of people were speculating that it could have been the Fed basically bailing them out. And why did the Fed? Because the Fed came right in the next day and started pumping, buying those assets as fast as they possibly could, and mortgage-backed securities. I don't care what you got, we'll take anything. Oceanfront property in Arizona, we'll take it. And they just kept trading those garbage assets or whatever, for bank reserves to provide the liquidity the market needed to bring those interest rates back down.
Once again, the Fed jumps in. So okay, before we wrap up, thank you, by the way. So what are some things that people should be watching in order to protect themselves moving forward as the Fed starts making their moves? Because I watch, as they start buying corporate bonds, I see that run, and I see, the money supply issue, and I see that run on the Bitcoin, and those are all indicators. So what are some of the things people can do or that they should be doing to protect themselves going forward?
I think a couple of key stats they can look at is the deficit the federal government is running combined with the amount of treasuries the Fed is buying. So, as an example, let's say that the government has an auction and they issue $100 billion worth of treasuries. Okay, well, then let's look at the Fed's balance sheet the next week and see if it goes up by 100 billion, right? Because then the Fed is directly monetizing the debt, meaning that the government isn't extracting money from the economy and then spending it back into the economy. They're just taking the money directly from newly created bank reserves that the Fed gives them. So if you look at M2 money supply, Ken, you'll see that in March or April of this year, it just went completely parabolic. And to the point where I think we've added something like $4 trillion worth of M2 money supply just this year. And to give people some context, prior to that, the entire M2 money supply for the United States was 16 trillion. So it's gone up there's 20% more currency units right now in the real economy than there was just, let's say, 9 months ago. So how on earth can that happen, right? Well, what happens is that when the Treasury is selling debt, they're not extracting any money. Because, okay, let's say that you and I bought those treasuries. Let's say you and I had 100 billion and we bought those treasuries from auction. Well, they would be taking currency units out of our deposit accounts in the real economy. They would be taking it out. That would be going into their account with the Fed. We call it TGA, the Treasury General Account. And then let's say they would take our $100 billion and write stimulus checks with it. So then that $100 billion would would go from your and I, a bank account, a deposit account, and then it would go into the TGA, then it would go back out into the real economy to another, let's say, million people in the form of these stimulus checks. So it would be redistributed. But my point is it's extracted in the first place, right? If the Fed is monetizing the debt, then they are the buyer, not Ken and George. Yeah. Therefore, the money isn't extracted in the first place, right? That's how you get M2 money supply going up so fast. So why is that important? So it's important because if the Fed continues to monetize almost 100% of the debt, and if the government continues to run these massive deficits, the most likely outcome is that the M2 money supply will increase, meaning the amount of currency units in the real economy chasing goods and services should increase significantly. Now, that's a big deal. Because remember, going back to our initial conversation, we talked about how the Fed is coming in and distorting the entire economy. Well, those distortions will most likely create an environment where our economy produces fewer goods and services in the future. So what you're doing is you're creating an economy that's producing fewer goods and services, but has more and more currency units chasing fewer goods and services. So pretty much you got to see consumer prices going up, which takes us back to a lot of what we've been talking about with fixed rate debt, with mortgages, a little bit of gold, owning hard assets, commodities, things like that.
Wow, George, thank you. That was a handful. But by the way, if you guys are confused, it's okay. Obviously that's why you want to watch this over and over and over. And if you haven't subscribed to George's channel, do so. George, even I'm going to have to watch this thing over and over and over, and I'm going to have a ton of questions. But I can't thank you enough for your knowledge and your wisdom. And let's keep this thing going. Let's keep teaching people. Thank you.
For sure. And if anyone wants to check out the channel, I actually do whiteboard videos on this. So I kind of draw it up on a whiteboard, and so it's a lot easier to digest if it's up there, so you can get a visual.
I know. I always like, well, if I ever want to know what's on your mind, I just go check your video out. It's like full of stuff. But you have a way of walking people through it that's really, really nice. So I love your videos, and thanks again. And so you guys need to go over to George Gammon on YouTube and check them out. And there's a lot more stuff on the repo market, the shadow banking market, inflation, Bitcoin, all that. He has some great guests. So George, thank you. As always, I appreciate your time.
Awesome. Thanks for having me, Ken.
You bet. See you, bud.